typically manufacture about 90% in China and about 10% in the U.S. And this has really thrown a bunch of sand in our gears and caused us to kind of reevaluate what we're doing. But it's difficult to buy capital equipment that costs $1 million or $3 million at a piece for what may be a short-term or 24 or 48-month trade situation in the U.S. So it's difficult to make the decision to add capacity, but it's definitely caused a bunch of sand in the gears to what we're trying to do and our normal trade partners in China.
So a lot of people don't know you because you're private. You're huge oil services, right, business. So when you say that this puts energy dominance at risk, what do you mean?
Sure. So a couple of things. One, the export story, I think, has been tremendous for oil, tremendous for natural gas. And China has gone from being something like the third biggest importer of LNG, of U.S. LNG, to 20th as a result of the tariffs. There's no tariff on oil specifically yet, but we've already seen China, a year ago, China bought about a quarter of the U.S. oil exports. Now that's trickled to 1 or 2% and going to fall to zero. So as far as U.S. oil as an export market, it's, China has basically been taken off the table. On top of that, as our costs go up, a lot of the stories you're doing are about the costs going up to consumers and the cost, and that's being a negative. But in the oil and gas business, we can't really raise our costs. Our costs are competitive with West African crude, with OPEC crude, whatever. So as our costs go up, we just lose market share. We can't really raise, the oil companies can't really raise the price because it's a world price for oil. So we're squeezed on both ends. So we don't even have the option of trying to charge the consumer more. That's not really how the U.S. Oil and gas competes.
You mentioned that uncertainty as to whether this is going to be a 12-month thing or a 36-month thing, and that makes it hard to make those capital allocation decisions. If you did know that this was a full-time, long-term issue, could you easily move your production out of China? And if so, once it was moved, would it remove the current 15% price increase, for example, you mentioned yesterday?
Sort of. So I think one of the implications, I think, of this trade war is a forced rebalance to other emerging nations. So places like India, places like Vietnam, and adding capacity there instead of not maybe what Trump was originally intending, manufacturing in the U.S. But that's much easier said than done. We've tried India. We've looked really hard at Vietnam. One of the problems with Vietnam is they don't have their own steel. So then you get into kind of a technical mix of does what you're manufacturing meet a substantial transformation test if it's made with Chinese steel but made in Vietnam and exported to the U.S. And I know there have been some, not my business, but some white goods that have been caught in this kind of gray area. But for us, it's a big concern. If we put all that impetus into adding manufacturing capacity in Vietnam, it may not even work because places like Vietnam and Indonesia, they're getting their steel from China.